Thanks, everyone, for taking some time out of your very, very busy schedules. We all know how hectic it is this time of year as we get ready for the tax season. But we also know how important it is to know the latest and greatest from the IRS as far as both its updates, as far as laws are concerned, as well as protocol. Let's go ahead and take a look at what our topics will be for today. First of all, important things that everyone needs to know. We're going to take a couple minutes. We're going to talk about the 1040 redesign, which if you've gotten the new program, you've already seen it, but it is something that we want to make sure we touch on. After that, we're going to talk about tax changes that have the biggest impacts to you and your tax-paying clients. We're going to talk about expired provisions, which is something that's very real this year. We're then going to go into states and some of the changes that have happened with regards to the states as they continue to do their own processing of returns. And we'll finish with the Security Summit updates. Again, every year there's a Security Summit updates, and the information that they pass along, or some of the recommendations that they pass along, are then passed to us as transmitters, as well as to you folks as tax professionals that you need to be taking or utilizing when you're working with your customers. So let's go ahead and start with important things to know. And the first thing is the Affordable Care Act and the fact that the penalty for not having health insurance. Please remember that it's still very much in effect for this year. So that's found on Schedule 4, line 61. When we talk about Schedule 4, that's a brand new form that's part of this new IRS forms on the Schedules 1 through 6 that support the 1040. And we can show you that here in just a little bit, but do understand that that's found on Schedule 4, and it still does apply. And what does that mean? If a taxpayer did not have insurance for all or any part of the year, they will still need to complete the Form 8965 to claim an exemption or pay the penalty. One of the things that's kind of misconstrued, or some people have confusion, is that with the new administration, was this still in action? And yes, the Affordable Care Act for this year very much is still there. So you'll still see the same questions when you're doing your client data, asking whether or not the taxpayer did have insurance over the course of the year. And if they didn't, and they want to consider an exemption, they are going to have to complete the Form 8965. Next up, the start of the filing season. And this is one of the interesting things that I think John talked about before, following us on social media. Guess what? The IRS has still not announced that date. However, we believe it's going to be coming soon. And so with regard to that, please make sure you're following us on social media, because as soon as that becomes available, the exact date, we're going to let everyone know. Right now, the one thing we can say is it's most likely going to be around the same date as last year, which would be Monday, the 28th of January for the upcoming tax season. So again, that's not in cement. I'm not saying that this is concrete or anything, but what I will tell you is that if it's like last year, it will be last Monday of the month of January, which would fall on the 28th this year. Other important things to know: delayed federal refunds. The IRS will delay refunds for returns with EITC or additional child tax credit, and that's going to be a delay all the way until the 15th of February. What does that mean? Well, first of all, the IRS messaging for these delayed refunds will be that taxpayers shouldn't expect to receive their refunds around the end of the month. So that's quite a ways out. I mean, if you remember in years past, it was much sooner that people would get that. If they're only going to begin processing those types of returns on the 15th of February, the IRS wants to make sure people understand that that doesn't mean they will get their refunds on the 15th. The processing will begin then, and people can expect to get the refunds at the end of February. And we should note that this will be the case from now on unless Congress decides to change the laws. And finally, that states are delaying their refunds as well for identity theft reasons. So in all instances, you can expect a delay whenever there's EITC or additional child tax credit. And with regard to the federal EITC and child tax credit, they shouldn't see funding on those until the end of February. Excuse me. Other important things to know when it comes to taxpayer expectations, and this is a very, very important thing to understand. There have been changes that were made to the laws, and because of that, there's changes to exemptions, standard deductions, even the limiting of itemized deductions and withholding calculations. What it's going to mean to some taxpayers is that they are going to be surprised by what their tax return is going to yield this year. The IRS has even gone as far as to begin messaging that due to the aforementioned changes, individuals may not see the same results they've seen in the past, and that they need to understand that that has nothing to do with the tax preparer or the software. Those should not be blamed, but yet people didn't make changes to what they had withheld, and if the laws changed and those types of things, that allowed people to get more money from their paychecks early in the year, if they don't have enough things to cover the withholding, that guess what? They may be finding themselves in a surprising situation. Now, a quick FYI, for most taxpayers with EITC, they're going to be impacted, but some may actually see a large refund due to the increase of the child tax credit. However, when you have taxpayers also that don't get EITC, they may see a lower refund or may actually owe money. It's something as far as you folks as tax professionals will need to make sure you're educating your customers on. Other things of note is that when it comes to paid prepare due diligence, please note that we have added, or more specifically the IRS has added, head of household filing status to prepare due diligence requirements. So other things is that credit for other dependents was added to the requirements of child tax credit, which we're going to show you in just a moment, and that there are changes to Form 8867. That's the pay prepares due diligence checklist, as we all know. And the checkbox for head of household was added to Part 1, questions 1 through 8, and that there's a new Part 4 added for the head of household filing status question. Now, what I'm going to do right now is I'm going to pop into the program, and in doing so, we can see right here the 8867, and here's your brand new head of household right here. And, of course, as I said before, there's even a new Part 5. And so here's your Part 5. Let's see right here, 4. Oops, I think I just went past it. There it is, Part 5, due diligence, and this is for your head of household. So this is all brand new for this year. Just note that when you're taking a look at your 8867. Also note that the $520 penalty for failure to comply relates to each credit that's being claimed on a return. And now with the head of household filing status added, the potential penalty for noncompliance can be up to $2,080 per every return. And why this is so important is people oftentimes feel as if they're out of compliance, they may get dinged with a one-time $520 penalty. But that's not the case at all. If the IRS does begin doing auditing and that they find that you're out of compliance, they're going to look for every instance on every single return. And certainly that can add up very quickly. So the IRS is taking due diligence very seriously, and we just want to pass that reminder along to you folks. It's not a one-time $520 penalty that you might be paying, but rather they'll look at every instance on every single return if they do an audit. Next up, we want to talk about the 1040 design. And folks, I'm sure many of you have already cracked your new software. You've already taken a look at it, but there are some things that we need to make sure that everyone understands. First of all, Forms 1040A and 1040EZ, they've been completely eliminated. And that the Form 1040 itself remains 2 pages long. However, the text will only take up about a half page on each page. What we also did make sure that we were able to do as a transmitting company is that the software companies are allowed to print the 2-page 1040 on a single page. Now, since they are shortened pages, what we did want to do is show you very quickly what's included on each page. So on page 1, you're going to find the filing status, taxpayer spouse information, the dependents, signature areas, healthcare coverage, and new checkbox for third-party designee. It's found on the right-hand side of the paid preparer signature line. I'm going to show you this here in the program in just a moment, but before I do so, I also want to show you what's going to be on page 2. So page 2 is going to have a little bit more information. Again, in both instances, they're only a half page long, but page 2 will have your wages, as well as the adjusted gross income found on line 7, your regular tax calculations, non-refundable credits on 1040 and child tax credits. Main refundable credits remain on the 1040, which include EITC, additional child tax credit, and American Opportunity Education credit. And please note that other refundable credits will actually be found on that Schedule 4. And I'm going to tell you about Schedule 4 as being one of the new 6 schedules here in just a moment, but I do want to pop back into the program for just a moment. And if we go to the 1040 itself, we'll notice that now it's a much shortened form. It's 2 half pages, but in those 2 half pages themselves, one of the things that you'll note is that it can be printed on a single sheet when you're doing your work, but it is a much, much shorter form than it was before. And how does the IRS do that? Well, quite simply, instead what they do is that they have schedules that are behind it, schedules 1 through 6, to help fill out the information. So if we go to add a form, we now find that here they are, schedules 1 through 6, that include additional income, non-refundable credits, other taxes, other payments, and even foreign address and third-party designees. you're going to find these in the schedules themselves rather than in the 1040. So popping back into the program itself, again, the schedules that we were talking about include additional income and adjustments to income. Schedule 2 will be for tax and the alternative minimum tax and excess advanced premium tax credit. Schedule 3 will be non-refundable credits. Schedule 4 will be other taxes. Schedule 5 will be other payments and refundable credits. And finally, Schedule 6 will be for foreign address and third-party designee information. So the 1040 is shortened, but it doesn't mean it shortens the work for you as the tax professional. Instead, you'll be using these correlating schedules that'll be behind it. Next up, we want to talk about the changes that will have the biggest impact to you as a tax professional as you're working with your tax-paying clients. I'm going to start with child tax credit. It's important to understand that new for this year, the eligible child to get child tax credit must have a valid Social Security number to qualify for the child tax credit. For children that have ITINs instead, they will qualify for the new credit for other dependents. This is a new field, the credit for other dependents. And the credit has been increased to $2,000 for each child, of which $1,400 is eligible to be refundable. Now, the age qualification remains unchanged. It's under the age of 17. And when it comes to that new credit we were talking about for other dependents, please note a couple of things. First of all, $500 non-refundable credit for children that are 17, 18, or a student between the ages of 19 and 24, and that the other qualified dependents that were previously eligible for exemptions can be found here as well. Continuing with the child tax credit and credit for other dependents, please note that both credits are included on one line. And that's going to be in the 1040 itself, and it's found on line 12. There it is right there. And please note the details of how both credits are calculated can be found on a worksheet in the 1040 instructions. Other things of note, when it comes to standard deductions, these have changed for the upcoming year. Please note that it's $12,000 for single, $24,000 for married filing jointly, and $18,000 for head of household. Continuing on, and this has a lot to do with some of the things we just talked about with regard to children and exemptions. When it comes to exemptions, suspended beginning in the tax year 2018. So what does that mean? The boxes for exemptions and the exemption line itself have been removed from the 1040 altogether. And there is an impact for single or married taxpayers with more than one child or head of household filers with more than two children. They're going to lose the $4,150 for each additional child, which means the taxable income will become higher. Please note that for lower income taxpayers, the child tax credit should more than offset the exemption deduction, unless, of course, there are a lot of children involved. Other big impacts, and this is going to be a big one for as you're working for people that like to itemize. So when it comes to the Schedule A, there have been some changes to itemized deduction changes. First of all, when it comes to medical deductions, the adjusted gross income threshold is 7.5% for taxpayers in 2018, 10% for taxpayers in 2019 and beyond. Beyond that, when it comes to taxes, please note that when you want to go ahead and you want to itemize these deductions, there's a $10,000 limit, total, complete, for your state, your local income tax, and your real estate taxes. And when you take a look at standard deductions, all of a sudden this is going to change the game, and you're going to find that most people are going to end up taking the standard deduction because of this. Also, miscellaneous itemized deductions associated with 2% of the adjusted gross income will no longer be allowed. And this includes employee business expenses that were included on the Form 2106 in the past. Continuing on with itemized deduction changes for Schedule A, very important when it comes to mortgage interest. And this is an update from the presentation that we actually did in November, so we want to make sure that you're very clear that interest on the mortgage or mortgages of an individual's main and second homes, they remain deductible. When it comes to home equity lines or home equity loan interest, it's no longer deductible unless it was used specifically to improve the main or second home. So in other words, if somebody has a line of credit and they want to use that type of thing to pay off debt or take a vacation or do any of those types of things, that interest is no longer going to be deductible. When it comes to casualty losses, only losses in presidential declared disaster areas can be claimed. And that claim must include the FEMA disaster declaration number that's found on Form 4684 in order to claim the casualty loss. Other big impact changes, the 20% deduction for qualified business income, or what we oftentimes refer to as QBI. First of all, for tax years 2018 through 2025, an individual may be able to deduct 20% of their domestic qualified business income from a partnership, an S-corp, or even sole proprietorship. If an individual's taxable income is below $157,500 or $315,000 for joint filers, the individual may take a deduction for the lesser of one of the following: 20% of the income from their business or 20% of their taxable income excluding capital gains. Now, when it comes to moving expenses, important to note that only members of the military are allowed to deduct moving expenses as an adjustment to income. Entertainment expenses are going to no longer be deductible. Now, let's go ahead and take a look at some expired federal provisions. First of all, the provisions that were extended back in February of this year, or excuse me, last year, were only for that year. In other words, for the tax year 2017. They were passed in February. Congress has stated that they would like to pass extender legislation again, but we know that they're just coming into session right now, and the earliest would be during the first 3 months of 2019. Individual expired provisions with the greatest impacts to your tax-paying clients will include, first of all, tuition and fees deduction, which is Form 8917, exclusion of gain from income of foreclosed home mortgage debt, which is found on Form 982, line 1E, and treating mortgage insurance premiums as qualified mortgage interest, which we do on the Schedule A. Also, there may be some legislation passed in short order pertaining to provisions related to hurricanes and or wildfires. Certainly those were devastating this last year, but they have not been passed as of yet. But stay tuned, and that's one of those types of things that you'll see updates from our Tax Resource Center, or you can go to our social media pages to find that kind of information. What I'd like to kind of finish with is two different pieces, the Security Summit, which we'll get to here in just a moment, but I want to start with states, because a lot of these changes that have happened have actually had kind of a trickle-down effect on our states. So what do I mean? Well, this year there are more changes than usual for states due to the passage of the Tax Cuts and Jobs Act. That's what we kind of talked about at the beginning, the shortened form, people having less withheld, all that good stuff. But what's really interesting is how the states have responded to it. Well, some states have additional legislation. Some states are not conforming. There are some states with partial conformity. And finally, there are some states with full conformity. It's not important to take a look at this list and try to memorize it in any way, but rather, the reason why we kind of present that for you is to make sure that you understand the previous slide that I just showed illustrates how much change is occurring at the state level. Think of it this way. About 10 states will have little or no change. Conversely, over 30 states will have at least some change driven by the tax law updates that were done. Now, some changes, just to note, include 4 states increased their EITC percentage of federal EITC, include Louisiana, Massachusetts, New Jersey, and Vermont. We also noticed that California and Maryland expanded access to EITC, Idaho added a child tax credit, and finally, states that take a percentage of the federal child tax credit may not include the credit for other dependents. Now, this impact really even goes farther. Think about this for a moment. Effective some of the changes to itemized deductions. Well, first of all, states may allow taxpayers to itemize even if the standard deduction is used on the federal form. So if everyone's going to standard deductions, that doesn't mean at the state level they may not allow itemization to take place. States may still allow Form 2106 for business expenses. A couple of slides back, we said that that's not going to be something that's going to be available at the federal level, but that could very well be available at the state level. And it's important that as a tax professional, you're staying up with regard to what the laws are for the particular states. You know, think about it. Therefore, they may have to create a state version of the Form 2106 if the state that you're working in wants to go ahead and allow that. Same thing with states may allow itemized deductions that are no longer applicable on the federal form. We talked about some of the things that went away, but that could mean that they may have to create, they being the states, may have to create their own version of a Schedule A. And we also note that states that add back state income taxes will have to take a ratio if the taxes are limited on the federal Schedule A and they have both a state income tax and property taxes. So there has been this profound impact, not just to what's happening at the federal level, but the states as well, and how they're responding to it is something that you're going to have to make sure that you're staying on top of as a tax professional if you're working in a state that also has state income taxes. Now, what I want to go ahead and finish up with is the Security Summit update. Let's start with EIF validation. We'll only take a moment with regard to this. There is no change from last year, but if you did receive a tracking number, a VCN, make sure you provide it during your bank enrollment. The only reason we say this, and you may have all done your bank enrollment already, we hope you have, but it is a good practice since the IRS will be tracking, and that tracking may begin taking place as early as next year. We don't know quite yet, but it is something to note. On top of that, what happens is the security and tax preparation is a big topic when we get the Security Summit. The Security Summits have folks from the government as well as the transmitting companies, all that good stuff. And one of the things that we come to find out is the IRS continues to emphasize the need for preparers to take data and system security seriously. That's something we need to make sure we're passing along to you folks. All the different things that we talk about as far as taking precautions to make sure you're protecting this valuable data that your clients bring to you. In the first 2 months of last year alone, over 350 preparers were breached. That doesn't seem like a lot, but if you think of each one of them doing 100 returns, 200 returns, 300 returns, whatever it might be, just think of the numbers of people that all of a sudden had their personal information compromised. Now, what has happened as an outcome is there are some action items that the IRS, as well as states, require software companies to implement. The very first one you'll see, the very first time you go into our program. When installing the tax software, users will be shown information on how to protect themselves from identity thieves and hackers. So when you opened our program for the first year, for the first time this year, you were going through your onboarding, your installation, all that good stuff, you would have seen something that really gives you information about how to protect your systems and protect your particular application. Now, you can go ahead and check a box, and when you do that, it doesn't show again, but this was specifically put in place because the IRS requested it, as well as the states. On top of that, states will begin requiring software companies to force subscribers to install updates within 10 days of the release. That's something that you're going to see this year. And with regard to any kind of online applications that are out there, one of the things that you're going to see is that for this year, software companies are going to begin asking subscribers if they want to volunteer or use a two-different method to comply with the two-factor authentication. Now, what's interesting about that is that in our programs, we're already putting that in place as well. So one of these things, all of these things are direct output of the Security Summit and the updates and what the expectations are for you folks as tax professionals as you're taking care of your customers. Now, I promised to kind of finish my presentation in about a half an hour, and that's exactly where we are right now, so we're doing pretty well. But I do want to kind of share something in closing. So when it comes to tax law updates, our Tax Resource Center is a great resource for updates pertaining to anything to do with federal laws, as well as any kind of associating protocol. And to reach that, you simply go to crosslinktax.com, you look for customer resources, and then you can go to the Tax Resource Center. And there you'll always find the updates, as well as John mentioned earlier, social media is a place that we also share those types of things. And you know what? There's something that's going on right now in which we're all very interested to see how it's going to impact. And so it's a perfect example of things that you want to stay on top of. You can always check with our Tax Resource Center. That includes information relating to the current partial government shutdown and its impact on the processing of tax returns as well as refunds. We know that it's getting to be kind of late in the game, if you will, and if the refund season, or more specifically the filing season with its correlating refund season, comes upon us, there's going to be some information that you're going to need to know as you're working with your customers. So please make sure you take advantage of the information that we share, not just in this call, but rather through our Tax Resource Center as well as social media outlets. So with that, that's everything that I wanted to present today. I'm going to go ahead and pass it back to you, John, and we'll be able to kind of entertain different questions or further information that you might need, and we have Mark Castro here to do that for us. So, John, I'm going to pass it back to you, sir.
Yeah, excellent, Steve. Lots and lots of information, so thank you for taking us through that. We do have a couple questions coming in that we want to make sure we go ahead and cover. Mark, this is probably one for you, and it's in regards to cryptocurrencies. How is that to be handled this year?
Well, cryptocurrency, the IRS considers that as this exact same thing as selling stock. So it's reported on Schedule D as stock, as a transaction, like a stock transaction. So you have to know what the basis is and what the selling price was, and as a gain or loss on each transaction that happens with cryptocurrency.
Perfect. Next question, slightly different topic, well, significantly different topic, and it's been asked a couple of times, and that's in regards to dependents living in Mexico. Has there been any changes this year in regards to claiming those dependents?
No, there's been no change in who qualifies as a dependent. So if you go to the 1040 instructions and look at what qualifies as a dependent, those have not changed. The only thing that's changed is that exemptions have went away and been replaced by the increased child tax credit and the new other dependent credit. So who qualifies for that? It still remains the same as it has been in the past.
What about a dependent that earns a small income, let's say $6,000 a year? Do they still file their taxes, and can they be claimed as a dependent, or do they have to be represented just on the return of the person claiming them?
Well, if they're not a child, considered a child, and they earn over the 4150, then they can't be claimed as another dependent. So
if they are a child?
If they are a child, they qualify as a child for either the under 17, 18, or if they're over 19 and are a student, then the income doesn't matter. But for the others that aren't, that are just other dependents, then the income limit of 4150 still applies. So they can't earn over 4150 to be claimed as a dependent on the parent's return.
All right. Steve, you can probably summarize this one pretty quick and the process for it, but are they able, are users of CrossLink able to upload returns prior to the IRS being ready again this year?
Sure. We began accepting those on the first of the year. Anything that was tried to be transmitted before then, we had sent a kind of during our away message, we kind of said that they would have to be done on or after the first, but we're definitely collecting those as of right now.
Excellent. All right. Any significant changes, Mark, to the Schedule C going into this year?
No, the only change is you can't take entertainment expenses anymore, but other than that, there is really no change to the Schedule C itself.
Excellent. Steve, early in the presentation, you had talked about the penalty, I believe it was $520, the penalty that they were exposed to. Can you just touch on that again really quick?
Well, when you're doing your due diligence, you're being asked to state, under a penalty of not perjury, but there is a penalty that's associated with it if you are telling the truth with regard to the information that you gathered. And if that's being checked, that's why we have the 8867 and the due diligence checklist that's involved with it. What the government is simply saying, and Mark, you can certainly chime in on this as well, the interesting piece is that a lot of times folks are under the misrepresentation, if you will, that $520 is all you can be fined if you're found to be out of adherence. And it's not that way at all. It's rather $520 per occurrence, and that can be on as many returns as are found to be out of adherence. So what we're trying to do is make sure that everyone's quite aware that it's not a one-time deal, but rather it's per return, and it can be found as many returns as you processed. And that's all we're trying to say is that please be very aware that when we're talking about $520, that's per occurrence, and there can be up to 4 occurrences on any particular return. That's it.
Okay. Mark, I don't know if you know this one off the top of your head, but is there still a Form 2106 this year?
There is a 2106 this year, and it's mainly for there's certain employees that can take that as an adjustment to income on a 1040. They can still use a 2106 for that, but you can't use a 2106 for Schedule A anymore. So the vast majority of people aren't going to be able to use 2106 because you can't deduct it on the Schedule A any longer. But there are still a subset of people that can take it as an adjustment to income on the 1040. So it still exists. And the 2106EZ went away, but the 2106 still exists for those people that can still take a deduction. The limited number of people can take a deduction as an adjustment.
One of the questions that came in, and obviously we don't touch on the political aspect of things one way or another, but it's in regards to time frames that some of these changes that came through, are they specific to the span of the current administration, or are these, as we sit here today, permanent changes that have taken place?
Are you talking about the tax reform changes?
Correct.
Most of those went from 2018 to 2025. That's when a lot of them, the vast majority of them, for the individual side, are good for that period of time. Some of them were permanent. The business ones, like the corporate rate change, and some of those were permanent. But the vast majority of the individual ones, such as the exemptions going away, the Schedule A changes, those were done from 2018 to 2025.
Excellent. Thank you. All right, we're starting to get near the end of our time. We've got time for a few more questions here, so I'll try to kind of filter through these. This is actually something the three of us have spoken about earlier today, which was due to the government shutdown, this individual has read a couple articles talking about the issuing of refunds and the impact that any delay or government shutdown will have on the issuance of refunds. You want to touch on that briefly?
Yeah, I can touch on it.
Well, right now yeah, go ahead.
Right now, the IRS, under their plan for shutdown, is that they cannot issue any refunds. So if the shutdown goes into the tax season, they will not issue any refunds during the time of the shutdown. And they're not issuing any refunds now, so if somebody filed a return, a prior year return or something right now, they would not issue refunds. They're not allowed to do that during the shutdown.
Okay. And I did want to highlight this. I've taken control of the screen just for a moment here. This is a good example of why we'd love for you to follow us on social media if you're not already, is that we post this information on our website. So you can see a post from earlier this week talking about what the impacts are, and if you have more questions about it, you can actually link directly to the Treasury Department's explanation for last appropriations or contingency plans for these types of scenarios. So we do this is the type of information that we make available to you on our social media channel. So one last pitch on that front. Steve, I'm going to hand the control back to you. Okay. You touched on this earlier, but just for a reminder for some that may not have been on at the very beginning, are there still penalties this year for those that did not have health insurance in 2018?
Well, you have an option. You can still do the exemption, which is the 89.55, but if not, penalties still apply. The law is still the law right now. So it is important. You'll see that when you're doing the client aid. I'm sorry, go ahead.
The penalty doesn't go away until 2019. So starting in 2019, the penalty for individual penalty goes away, but for 2018, it still applies.
This one's pretty straightforward, but if they have 15, 16, 17 returns that they need to file, when can they file those? Old returns.
You can file them anytime they want. Do you file about electronically?
I don't have clarity on that, but I think that the answer is if you have any legacy returns, they can be filed at any time.
At any time, yes. Sure. IRS will not, if you send them in on paper right now during the shutdown, the IRS will not process any paper returns. But yeah, they can file those whenever they want.
Okay. And then this one's one that's come up a couple of times over the course of the last couple of months, and that's in regards to alimony. and the grandfather date for which your order was issued and whether that alimony is still deductible at the federal level.
It's for any divorces that happen starting in 2019 and beyond. It's not deductible and it's not reportable as income to the recipient. Divorce decrees before that, as far as I know, but still, they still would apply. You'd still be able to deduct it and they'd have to report it as income. But once the divorce happens in 2019 and beyond, then those new rules go into effect.
We're going to have to wrap up the questions here pretty quick, just to be respectful of the time frame we've set forward. Steve, I don't know if you're able to answer this, but this is a general question. It's a little outside the topic, but it's been asked quite a few times so far today, and that's in regards to any impact that the government shutdown may have on advances.
Well, advances are very much with the banks, the banking partners that people have. So what you'll want to do is you'll want to check with them. It's a very valid question, but you always want to check with your banking partner because they're the ones that do the funding and the application goes through them. So when you're looking at a situation where there's going to be a potential delay in the processing of the return, which is, of course, what's used to cover that advance, you'll want to definitely check with the banks on that and what their protocol is going to be.